Market timing is an intriguing concept. Imagine if you could be in the market on the good days and actually be out of the market on the bad days. I mean, that's the basic premise of it. Some people try, most people fail, and so I wanted to show you why. There is a number of other behavioural biases for humans that make us try to time the market. In some respects, we can't help ourselves. And so what I wanted to do is just go through a couple of those biases that, as experienced sort of fund managers and investors, we try to drown out that noise. For others, we can't help ourselves because it's hardwired. The interesting thing is you don't know when the market is going to respond. It's unpredictable. And there's a large body of science and research done on this, and it's called random walk. And they've proven that stock prices are a random walk. You can't use past prices to predict future prices. There was another study done by Delbar in 2016. He studied a number of market timers over a period of time, and he found that if they just stayed invested, they would get 8.19%. They, on average, got 4.67%. Why I wanted to highlight this study in particular was actually what he said, though. What he said in the study was the data also shows that when investors react, they generally make the wrong decision. So they generally make the wrong decision, so therefore they're less than 50% of the time, whereas the study before showed you have to be at least 60% right of the time. I think this is probably the most compelling one, though. It's the cost to market timing, especially in Australia with our tax regime. But the cost to market timing of actually buying and selling the shares, so you've got brokerage, you're chewing that up. But the big one is actually capital gains. In Australia, we get 50% CGT relief on capital gains if you hold that security for longer than a year. If you're getting in and out all the time, that means you're giving money to the government. And that means that's less money in your investment portfolio compounding over time. How do we do it? How do we think, if market timing doesn't work, and hopefully I've convinced you of the challenges of market timing, how do you do it? Well, we believe in rebalancing time from time to time, and it's a more disciplined approach. What we found for a balanced portfolio is we only had to rebalance 4 times over 20 years, and we increased our returns by about 1%. So it's got nothing to do where we think prices are going to go. It's got to do with the fact that where your exposure is and making sure that that's in line with whatever your risk profile is. We think compounding interest, making sure your money is in the markets, making sure it's diversified across asset classes, making sure it's in line with your risk profile is the best way to make money over the long term. So we believe in also regularly and consistently contributing to your funds. Most of you here are probably in sort of like, retirement phase, but definitely for younger people, you should be consistently adding to your well-diversified portfolio. That's called dollar cost averaging. It's another way to smooth out volatility. And lastly, but not least, making sure you rebalance from time to time. You don't have to do it every day or every week or every month or every quarter because you're just going to chew up brokerage costs. We think when your health check gets out of about 75% alignment to your risk profile, you should be having a good look